Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today I'm going to get my crystal ball out and talk about what I think is going to happen in the commercial market in 2026. Now, I've not really got a crystal ball, and what I do actually is read the data, and also I've got 30 years experience of cycles. So I think once you've seen a couple of cycles, this is my third cycle that I've seen in the commercial property market, I think you start to get a picture of what may happen, but every cycle is different. So I'm going to give you my best guess as to what I think is going to happen next year and where the opportunities are. And obviously that kind of intel is so important because whilst we never really want to wait for the bottom, it's kind of more luck than judgment when you invest at the bottom of the market, because you can only really tell in hindsight. We want to make sure that we're buying well, that the pricing is good, and that we're making the right decisions with our property investing. So let's get going. So first of all, let's look at the macro picture in terms of where 2026 is going to be. So there's obviously a lot happening in the world. If I had to summarize kind of what's going on at the moment, I would say there's a lot going on. Globally, we've got Trump and we've got wars and, all kinds of stuff going on. We've obviously left the EU. That has had a big impact. I think only the impact of that will only be realised in decades, actually, on the impact on the British economy. But if you look closer to home, then obviously it's been a pretty turbulent time, not particularly helped by a government. And this isn't a party political broadcast, far from it, actually. But the markets are not feeling this government in terms of the boosting of economic growth. They don't think that they're doing the right things to boost economic growth. And obviously we've got a huge hangover from COVID, and it's difficult for any government that would take over. But I think that, taxing businesses, taxing the consumer is really affecting confidence, has affected confidence. And the markets have reflected that both in bond yields and in the price of the pound. So we now have an environment where there's rising costs. We have an environment where interest rates have been pretty high for the last couple of years as well. We have an environment where business confidence is quite low. And obviously that's really important for commercial property because it is businesses who are our tenants. So we take note of that. Now, I'm kind of breaking a golden rule when I say that, because it's very, very dangerous to generalize in the commercial property market. That's exactly what we don't want to do. We want to make sure that we are we're niching, we're looking at each sector, because every sector of business is performing differently in this environment. There are real winners and there are real losers, and then there are a lot of people, kind of a lot of businesses in the middle. So it's very dangerous to generalize, and we just need to make sure that we understand our niches that we're investing in. And that's why I talk about niching the whole time, because we've got a backdrop, a macroeconomic backdrop of uncertainty, of nervousness, but there are certain sectors that are just booming. There are certain locations that are booming. So the first thing I'd like to leave you with really is to make sure that you understand niches. I've been working with clients today on a niche that is hugely, hugely profitable. And, as long as they can kind of really get under the skin of it, and that's the skill. A lot of people don't want to get the knowledge or spend the time getting the knowledge they need to become an expert in their field. And if you can do that, if you become an expert in a certain sector or location, you can absolutely beat the market through your investing. So macro picture is, I would say, relatively bumpy ahead. if you believe in the 18-year cycle, then we are due a correction next year in 2026. Whether that's going to happen or not, I don't know. You can't foresee black swan events when they happen. They just happen. That's the whole nature of them. So we just need to wait and see. But obviously, what we can look at is where the opportunity lies in 2026. And, we think that interest rates are going to come down in 2026. So that's a really good news. Stability is gold for commercial property. It's really, really important because the market's all about sentiment. All financial markets are about sentiment. They're about how people feel, how confident investors feel. And so with interest rates coming down, that will boost some confidence. We just need the reaction to the last budget, November 2025 budget, was actually not too bad to date. Obviously, markets can react later, but it was actually better than the November 2024 budget. So let's talk about some key sectors that I think are, really going to shine in 2026 or could be good opportunities for investments. So first of all, industrial and logistics. So, e-commerce growth continues at around 8 to 10% annually. And in a lot of locations, demand can outstrip supply. And obviously that is the pure gold for commercial investing. And there isn't much industrial property in local plans for development. And so therefore, there's a real emphasis on housing development, but not a lot on industrial. But there's a lot of businesses, especially with the introduction of Class E into the old Class B1C, there's a lot of businesses that can operate from industrial units. And so I think there's still a real opportunity in the industrial sector. Yes, the pricing might be a bit punchier than we'd like it to be, but, rents are definitely climbing, and it will definitely depend on business confidence. We did see a lot of tenants kind of hesitating to take space pre-budget. They were worried about what Rachel Reeves was going to say, but now that budget is over, it probably hasn't hit business quite as badly as anticipated. In fact, it's actually hit the consumer more. So if you're looking at kind of a strategy for 2026, then B2B, business to business rather than business to consumer, potentially might be where the tenant demand might be, because B2C businesses are going to be hit by consumer nervousness and reluctance perhaps to spend money as much as they have done. But I love the strategy, industrial strategy, dividing up into smaller units, just letting great industrial estates. I with my board, we recently went on a field trip. We looked at two very different types of industrial estates. One, very, very small units, all operating out of Class E. And the second, just a very traditional industrial estate, but again, fully let, really fantastic investment. So, it's all about the demand and the location and, the size demand. And we're seeing, in some places, we're seeing very small units actually rents doubling from larger units. In other places, we're actually seeing larger units getting good rent. So it's very much kind of location specific. I think number two is retail. I think that there's a comeback in retail. We saw a lot of basically values were slashed during COVID. And there are some locations where I just wouldn't touch retail with a barge pole. But, retail parks are definitely outperforming high streets now. And service-led businesses like dentists, vets, cafes, salons continue to thrive. How many people have seen the number of barbers and hairdressers on a high street, but also the kind of number of health uses as well as the NHS gets restructured. And I think there's now a recognition that, there's like a rebasing of rents in the retail sector. But so retail isn't dead, bad retail's dead. And, there's certain locations where retail is absolutely booming. And again, the skill is in choosing your niche and choosing your investing location so that you can find those niches. Third, offices. Well, grade A offices continue to do really, really well. Obviously, they tend to be the preserve of some of the larger investors, pension funds, etc. But if you've got secondary offices, there's so many different uses that they can be repurposed to, and it doesn't have to be residential, although it can be. Multi-let offices in CMOs, commercial and multiple occupation. You've got a huge range of uses that will take secondary office space. And it's really important, that you work out what the demand is in areas, because there's some areas where, clients are investing where there's just not enough offices because a lot have been repurposed into residential.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
The important thing is that you don't overpay for those assets you have multiple exits. That's the golden rule for all commercial, but particularly with secondary offices. Obviously, EPCs are really important for those kind of assets because they're relatively old. So you definitely need to understand the EPCs as well. And then there's kind of all the alternative sectors like health and well-being, massive boom sector, operators expanding, multiple uses, flexible workspace, drive-throughs, roadside retail, absolutely booming. And since COVID, there's been a real rush of money into alternative investments. And, apart hotels is another very interesting multitude of opportunities. I've got clients investing in very, very niche properties, very specialist sectors that you just wouldn't think about in commercial, but actually incredibly strong demand. And that's what we're looking for. Ultimately, we're looking at markets and sectors where supply is much less than demand, and demand far outstrips supply. That's the fundamentals of successful investing. And obviously we want to make sure there's a longer term story in terms of demographics, in terms of demand, in terms of fundamentals. So for example, industrial near lots of chimney pots to employ their workers, and also near arterial roads and motorways. They're the fundamentals of what we're looking for. In terms of lending, lenders are definitely, rates have fallen, loan to values have gone up, but there's a bit of a game to play because lenders have certain preferences. So a strong appetite for industrial, retail parks, medical, stable offices, grade A offices, lower appetite for more single lets, but you can still get lending on them usually. The rates may not be quite so good, but multi-let is what lenders are really liking at the moment. It mitigates both you as the investor, your risk, and also banks' risk. So, really growth sector. And SaaS lending is increasing because you can invest in a SaaS or you can lend from a SaaS into commercial. And so definitely SaaS lending, predictable income, long leases, everything that you want in a pension. So now is potentially the year to either investigate a SaaS or to a SaaS, a self-administered pension scheme, or to kind of nurture SaaS relationships as well. So what will pricing do? Well, that really is where a crystal ball comes into play. So it's very difficult to shout. But I think that there's been a lot of vendors that have been holding off for the last 2-3 years since the market dropped and thinking that things are going to recover. And I just can't see that happening next year. I think that we may see some form of recovery, or we may even see a false dawn. But I think that there's vendors now who need to sell, and probably are sick of holding off. So I suspect we're going to see a lot more stock coming on the market and a lot more motivation. And I think the gap between vendors' expectations and investors' expectations, buyers' expectations, they've been quite a long way apart recently. And I think that we're going to see those kind of narrow slightly. So I think we're going to see more realism from both parties, actually. I mean, I'm still seeing asking prices on a lot of property, not all, as way inflated. And, I think that there's a lot of unrealistic expectations out there, which I think will temper in 2026. So it definitely is going to be interesting in terms of yields. I can see that yields may stabilise, but it does depend on whether there's some form of economic shock, or what happens with government policy, what happens in the next budget, because really we are confidence, business confidence, consumer confidence is pretty low, and what it can't deal with is any more blows. And of course, when you're dealing with business confidence, you're dealing with tenants. So, if businesses don't feel confident, they're not willing to take long leases, they're not willing to, commit to expansion plans. And so that's exactly the market as investors we don't want to see. We want businesses to have lots of confidence. They're being hit every which way: minimum wages, national insurance, business rates. So, rent is the only thing that can give. So, we need to make sure that we're investing in absolutely the right kind of stock where there's good tenant demand. Otherwise, we're going to see rents being chipped when we're reletting. So I think there's some great opportunities for investors in 2026. The window of opportunity that has been open for the last 2 or 3 years, I think is going to continue well into 2026. I can see there being some fantastic opportunities. I've got clients getting substantial discounts from asking prices now. And I think there will be some more realism than we've seen in the last couple of years in the market. And that can only present great opportunities. So, great opportunities to reposition tired assets, old EPCs, where you can improve those, tired landlords who want to retire, lots of baby boomer ownership of commercial property, and therefore, a lot of them looking to retire, getting sick of investing, sick of the changing environment in commercial, perhaps families inheriting property that they just don't want to be involved with. So, I'm getting a lot of deals that way. So it's definitely worth kind of looking at off-market opportunities. And I think that if you can reposition assets that maybe haven't been managed that well, from tired landlords who maybe have lots of leases holding over, not being kind of really on top of their rent review, lease renewal strategy, rent review strategy, etc., then there's going to be some fantastic opportunities, some great asset management opportunities. And of course, we don't need to do loads of development very often with commercial. We can just do paper-based asset management strategy, and that's one of the real benefits of commercial. So I think there's going to be lots of distress, or probably not so much distress, more fatigued landlords. I think that's probably a better way of saying it. And don't want to fund any upgrades, finding that tenants aren't renewing leases and just want to offload property. There's some great opportunities in mixed use. I'm finding, where there's kind of 3 to 4 flats plus above a shops. Then there's asset management angles usually on both the retail or the Class E and the residential, and there's some nice opportunities in that space. Definitely in industrial, smaller industrial units for sure. The strong demand, minimum management hassle, predictable tenants, like it's a nice market to be in, and lenders really like being in that market. But there's loads of specialist niches where there's some great opportunities: health and well-being, apart hotels, very specialist kind of renewable type, EV charging, etc. So some really interesting opportunities there. Some risks to watch. Well, definitely it's worth watching the bond yield market, because if bond yields go up, then commercial yields have got no hope of lowering or prices going up. And also, so economic confidence is very much tied in with the commercial property market. EPC regulation, we're in 2026, we're only going to be a year away from the tightening of EPC regulations. So that's definitely something to watch out for. Rising costs as well, that just seems to be a predictable part of life now. Businesses seeking shorter leases and more flexibility in some sectors, particularly in very secondary or tertiary or quaternary retail. And just watch out not to pay. I think that's probably the biggest takeaway I'll leave you with on risk, is that, just because you've got 10% or 15% of asking price doesn't mean you've got a good deal. You need to stack it kind of at a level where you're going to be able to add value. And that is really, really important. So I think we're going to see a relatively stable lending market, interest rates coming down, which is really good. I think we're going to see more realistic pricing than we've seen in the last 2 to 3 years in the commercial market, and that can only mean a good thing for investors. What I would say is that there's never a right moment to invest in any type of investment. I think you can only read the bottom of the market when you look in hindsight. And I think ultimately there are so many great deals to be done at the moment. I've got clients doing great deals right, left and centre, where they're all money out deals. And so it's not one of those markets to wait. It's one of those markets to really start to dive into, make sure that you've got the knowledge and are prepared, because it really is a market of opportunity. And we don't see these markets very often. They come around probably once every decade, once every 15 years. And so we need to make sure that we capitalize on it when we can. So I think 2026 is going to be a huge opportunity for investors. I think that there's the market's going to continue to be full of opportunity, but the absolute key is that you don't overpay for your assets, that you make sure that you can force value through, i.e. you don't just sit and wait for the market to improve. You need to do your own asset management and reconfiguration, lease extensions, reletting, whatever that might be. And you niche your strategies. So you make sure that, you make sure that you niche your strategies and you invest in a sector or a location where you know that there's fundamentally strong demand for the units you're looking for. So 2026, great opportunities. Stay tuned here. I'm not going anywhere. There'll be lots more episodes of the Commercial Property Podcast, and I'll be here holding your hand in 2026 every step of the way. Thank you so much for listening in 2025. I've loved having you on this journey with me, and I really look forward to seeing you on the other side of New Year back in 2026 for all the opportunities that are there. So have a fantastic, very, very happy, restful and peaceful New Year, and I'll see you in 2026.